Hi, in this video, we're going to be talking about the Section 121 capital gains exclusion. With the real estate market being so hot right now, I figured it was the perfect time because what the 121 exclusion does is it provides one of the most significant tax benefits to the sellers of a primary residence. So especially if you're thinking about selling a home right now, you really don't want to be unaware of this huge opportunity that's available. And unfortunately, I do meet with a lot of people who aren't familiar with this really powerful tax benefit. So there's a couple of important items to know, and I think you'll really benefit from. So let's review exactly what it is. I'm going to pull the information directly from the IRS website, and then I'll show you an example of just how powerful this savings can be. All right, so here we are on the IRS website, and the first thing we should discuss is what exactly is this exclusion? Well, the Section 121 exclusion allows primary residence holders to sell their properties and exclude a significant amount of taxes from the gain of the sale. Specifically, if you're single, you can exclude up to $250,000, and if you're a joint filer, up to $500,000 from the gains that would otherwise be taxable from your sale. So these are enormous amounts that we're talking about. Really, it can be extremely powerful in keeping money in your pocket and avoiding paying a little extra to Uncle Sam. So what do you have to do in order to obtain this tremendous tax savings? Well, as it lays out here in the IRS guidelines, you need to be inhabiting the home for at least 2 of the previous 5 years. So this is really important for anyone who's potentially thinking about a property as a rental. Because one of the things you may want to consider is if you are thinking about renting it out, but also potentially selling it down the road, not being aware of this rule could cost you a lot of money. If you're just living in the home indefinitely, well, it's easy. As long as you're not renting it out, you're automatically going to qualify as long as you've owned the home long enough. So in this case, you would, again, need to be living in the home for 2 out of 5 years, which really is a qualifier for renters. Let's say, hypothetically, you had only lived in it for 1 year, moved out, and then rented it out. Well, now you're not going to be qualifying for this exclusion. So if you go to sell the property down the road, there's some significant savings that you potentially left on the table. So in doing your analysis on the rental, was the cash flow that you received worth the tax savings that you ultimately may have gave up? So it's just something to be mindful of, and I'll walk through what some of that math looks like. But this is really the important piece here. So you're eligible for the exclusion right here, again, as you have lived in the home for 2 of the last 5 years. So really, really important piece. Living in San Diego, I also wanted to point out there is a nice benefit, and it's really an appropriate benefit for our active duty military here, because if they're doing a tour or anything that pulls them out of the property, well, obviously that's unfair to lose that benefit. So you can see that they do make a suspension available for anyone who is serving overseas, which is really appropriate. So these are really critical. How critical? Well, let's just walk through some of the math here. So typical capital gains, so if you have any gains on that property, in most instances it's going to be long-term gains if you hold it over a year. And you can see here the capital gains rates. Again, this is pulled directly from the IRS website. And I think it's most appropriate. Let's go through what typically, let's say the maximum gain would be, which is 20%, so that you can see what the math would look like. Well, really easy here. Just pull up an example. We'll say, just to make this easy, you purchase the property for $500,000, and you've held on to it now, let's just say for over 3 years. You've been living in it, and that property has appreciated to $600,000. Well, that is now, you do the math here, a $100,000 gain. So if you are not qualifying for this exclusion, that would be subject to a long-term capital gain. And again, let's say you're falling into that 20% rate. Well, you just paid $20,000 to Uncle Sam. If you do qualify for the exclusion, you are not paying anything, because that's exactly what the 121 rule is. And so you've literally just kept $20,000 in your pocket from qualifying for this exclusion. So it's really, really important to be aware of, again, especially if you're thinking of real estate as an investment opportunity and you're weighing the pros and cons of potentially moving out and renting out the place, this can be a really critical piece when you're working through your numbers to make sure that the investment return that you're going to get outweighs the tax benefit that you otherwise would have from if you ultimately think about selling the property. So hope this is really helpful. Again, this can be one of the most important tax benefits available. So just something I wanted to bring to your attention. If you like this type of information about keeping more money in your pocket, go ahead and hit that subscribe button. We have a lot more videos coming. Certainly appreciate you tuning in. We'll talk to you again soon.